All right, so today we're going to wrap up the course. It's hard to believe that that day has finally arrived, but we're going to go over chapter 7, which is or section 7, which is our look at the binomial option pricing model, which is what we will be using to price American options. Because as we know, the Black-Scholes model can only be used for European style options. So this model first appeared in print in 1976 by researchers named Cox, Ross, and Rubenstein. And it was interesting that, like so many other breakthrough papers, they weren't fully aware, apparently, of how important this would turn out to be. In fact, they stated their goal in writing this paper to take the Black-Scholes model and basically break it down into smaller steps so that it would be easier for everyone to follow exactly what's happening. But what they did was they created a framework that suddenly made it possible to stop at different points in time and decide, should we exercise the option early or not? So in other words, this is what the the real problem is with the Black-Scholes model as far as pricing American options. What's basically happening is that they're describing a probability density function, and they're showing how it evolves from today directly to the maturity date of the option. But you're not seeing what's going on in between. And it's not possible for the model to stop and say, well, what would happen if in 1 month the price of the stock goes up to here or down to here? It's just basically it's modeling today and what's going to happen at the maturity date of the option. Whereas this model is taking the entire process and breaking it down to a series of discrete steps. So we can inspect each one, and at each point, we can make a decision. Do we or do we not exercise the option early? So this is why suddenly it becomes possible to price American style options. And for that matter, it could be used for exotic options, but it's not really practical because exotic options can often have properties that are so complicated that the binomial option pricing framework isn't really the best choice. Um, Usually for that, we use Monte Carlo simulation, where what you're basically doing is you're making assumptions about the statistical properties of the asset underlying the option, and then you're generating a, what amounts to a probability distribution of future values for that asset. And then what you're able to do is show how that price evolves over time. And so in the case of exotic options, where the entire history of the asset is important, it is actually possible to keep track of that information and then use that to price the option. So yeah, exotic options, very, very different from the traditional plain vanilla options that we're used to seeing. Um, Now, I did post a slide for exotic options if you want to look through them. Like, for example, let me just quickly show you while we're talking about this one in particular, where there's a type of option called an Asian option. And these names, by the way, we don't know. I mean, traders dream these names up. They have nothing to do with geography or anything like that. It's just somebody decided, let's call it an Asian option. And what's happening here is that if you can imagine, here's the asset price. This is a timeline, by the way. This is today. And this is the current price of the asset. We'll call it S0. And so this will be our maturity date for the option. We'll call it capital T. And so what's happening here is that, let's say this is an Asian call, and the strike price is 50. Let's say that would be. So what happens is the stock evolves, and on the maturity date, since it's a call, we will profit usually if the stock price ends up higher than the strike price. So if this were a European call, we'd have a payoff right here. This price, we'll call that S capital T. And this would be the payoff, X rather, if for a European call option. But with an Asian option, what's happening here is that we've chosen in advance several times. Let's call this T1 T2, and T3. And so what happens here is that there are going to be stock prices on those three dates. And depending on how the Asian call is structured, the payoff ends up being some function of those three stock prices. So you might end up with something like this. I need the max in there. So what you're basically doing is you're not comparing the stock price at time t to x. You're comparing the average stock price at those 3 points in time to the strike price. So that makes things a lot more complicated, doesn't it? Yes, it does. And so this type of option is often called path dependent because the value of the option depends not just on where the stock winds up, but how it got there. Because if you had a different path, let's say that instead the stock had gone this way, we still ended up at ST. The European call wouldn't be affected by this, but the Asian call certainly would because you can see the S1, 2, and 3 would be quite a bit lower. In fact, it actually could end up finishing out of the money in this case. So by the way, what's the point of an Asian option? The whole idea here is to hedge the average price of the stock or whatever the asset happens to be over that time interval instead of at the final date. Okay, so in other words, imagine yourself needing to buy gold. If you're going to buy gold at time capital T, then you might as well buy a European call option. That's fine. It's easy to hedge that way. But if let's say you think you're going to need to buy gold at times T1, 2, and 3, and you're worried about the average price fluctuating, then an Asian option might be your better choice, just because it enables you to hedge that average without needing to buy a separate call for each of these three time steps, which would be dreadfully expensive. So it's kind of a compromise. It enables us to hedge the average price over that time interval. But here's the thing, try pricing this with the European, with the Black-Scholes or even the binomial option pricing model. It's going to be very difficult. With Monte Carlo simulation, you're actually generating that entire path to get from the beginning to the end. So you are actually recording all this information. And so what you're effectively doing is you're running the paths a large number of times and calculating the average price over all those paths with Monte Carlo simulation. So it's a very interesting area to study, but we sadly don't have time for it, but I can make the notes available to you if you want them. Basically, it comes down to the idea that we assume a statistical property for this asset, and then we generate that through time. And that's how we get our results. So the beauty of Monte Carlo is you don't really need a whole lot of market prices, but you do need to make some serious assumptions about whatever it is you're pricing. So it could, oh, and the other thing too, the unfortunate thing about Monte Carlo is it's horribly time consuming. These models are very quick to implement. The Black-Scholes model in particular it's very fast. The binomial option pricing model is probably not much slower. I mean, especially now the way computers are, computing power is just accelerating all the time. And so when this 1976 paper came out with the binomial option pricing model, it may have seemed like this was going to take a very long time to run, but at this point in time, this processing speed is not a problem. So for Monte Carlo, even with today's high-speed computers, it can take a very long time to get results. That would be one of the major drawbacks to it. So that's why we usually reserve it for special cases like exotic options, like this one here. And by the way, not all exotic options are path dependent. Okay, that's just a special feature of the Asian option, but all path-dependent options are considered to be exotic. Okay, so that's what that's all about. And there's so many others. If you look at the slides that I posted, you'll see there's some really bizarre ones, and pricing them is a real challenge. So, but you might remember that we did discuss right up front that Options can be found on either exchanges or they can be found in the over-the-counter market, which is unusual. The other derivatives are all one or the other. And so what happens is imagine you're running a company who has a very strange, very not strange, but unique set of hedging circumstances that you don't find very many other places. The great thing about this is you can go to the over-the-counter market and find a counterparty who will write this option or sell it to you. And that way you can customize your hedging strategy with the counterparty. So like I could call up Goldman Sachs and say, listen, I'm running a company that buys gold at erratic intervals and I need an exotic option, like an Asian option. And they'll say, sure, we can structure that for you and we'll put it together. And here's the price. And then you sign a contract and there you go. Okay. So that's how this works. In fact, I've met people who work on these teams that design new derivatives for clients. And what's interesting is that they told me that on one of these teams, half the members are financial engineers and half of them are lawyers, securities, especially securities attorneys, because really what you're doing is creating a contract. Okay. Yes, it's a financial security, but it's a contract between the buyer and the seller, and they have to cover every conceivable contingency in those contracts. So it's a very specialized area of law, securities law, that is. The people who practice this stuff, let's just say they get paid very well. Okay. All right. Anyway, so back to this. The binomial option pricing model, as the name suggests, is based on the binomial distribution from statistics. And so essentially what you're doing is, let me just give you a little sketch. So you can get a sense of where we're going with this. The first thing that we need to note here is that we are assuming the same things as Black-Scholes. The implementation of this model can be very different from one source to another. What we're looking at here is the original Cox-Ross-Rubinstein model. But since they published that paper, many researchers have come up with alternative ways of approaching the same problem. They're basically trying to work around some of the complexities of it. And so it's one of these cases where there's different ways we could generate this model. And this one was designed, like I said, to basically explain to people how the Black-Scholes model is working. So they came up with this notion that at any given point in time, if it's small enough, we can make the case that over this very small interval of time, the asset or stock price, as the case may be, is only going to do one of two things. It'll almost certainly go up or down. It's possible it'll stay exactly where it is. And by the way, that is the heart and soul of the trinomial option pricing model, where they allow for the possibility of a price to go up, down, or stay where it is. Here, the only problem with that is that it makes things a lot more complicated. Here, we're just going to assume up, down, and that's it. But we're also going to assume that if it does go up or down, it's always by the same amount. Or I shouldn't say the same amount, the same percentage. Okay, in other words, we're going to have a stock price. Let's say here's the stock price today. And in the next step in time, it's going to reach one of two values. Okay. And so we could call this. Now, by the way, the notation that they use in this model is very interesting. Instead of having a subscript that indicates time, we'll let S be the S0 be the initial price. And if it goes up, it's going to go up by a constant multiple, which will simply be called U. If it goes down, it'll be by a constant multiple called D. Okay. And then if it goes up again, now in time period 2, from each of these, by the way, these little dots, we're going to call these nodes. And of course, the lines we're going to call these branches. Okay, you have to imagine this is basically a tree that's growing sideways. So actually, we need a node right here. This is the initial node. The others are called the interior nodes. And then in the last time step, wherever they are, they're called terminal nodes. That would be, let's say this is a 2-period model. That would be these guys. Okay, so now a couple of things to point out. If we go up again a second time, it's by the same multiple u, so that means we're reaching the value u squared s 0. If we go down, we've got ud as 0. So up and then down brings us to ud as 0. Now, if we go down and then up, we also reach ud as 0, which in principle could also be written as du as 0. It's the same thing. Okay, so in other words, if we go down and then up, you think you would call it du as 0, but it doesn't matter because they're both the same thing. And then finally down here, this would bring us to d squared as 0. So a couple of things to note here. First of all, the d and the u never change. They're constants. Now, they were derived, as we'll see, from the volatility of the asset price. And also what's interesting is that we go up and then down, it'll bring us back to the same point as if we go down and then up. Now, in later models, that's not always true. Here, it's staying, we're keeping this assumption because, among other things, if we don't, it'll become a lot more time consuming. There'll be a lot more calculations involved. But also, because of the assumptions we're making, we can justify having up and then down be the same as down and then up. In other words, this is what's going on in the Black-Scholes model. And so this is said to be a recombining tree. For that reason. Okay, so if not, here's what would end up happening. You'll see pretty quickly why this is so important. Imagine we did not have a recombining tree. What's going to happen is when we go up here, we have u as 0, ud as 0, du as 0, and you notice these are not equal to each other. So, you might think, well, what's the big deal? Well, in this case, the number of nodes at every time step is just t plus 1. It increases linearly as we go further out into time. With this one, it's going to be t squared nodes at each time step. So in other words, the number of nodes will explode if we allow this to happen. So now for some of these more sophisticated binomial models, well, I guess they're willing to put up with this because it probably is more realistic to assume this, but this one works just fine. We can prove that this model always converges to the Black-Scholes price of an option. And so we'll stick with this approach now. But if you were to continue studying all these different models, you'd see that there's a lot of assumptions that can be loosened, but at the cost of a lot more complexity. Now, one thing that we're missing here, and this is going to be a very important detail, is the probabilities of going up and down, because what we're basically creating here is a probability distribution. So you'll see later on that probabilities are simply referred to as P and 1 minus P. And these are also a constant. They never change throughout the problem. So the question is, where do those come from? And that is a very complex discussion. Those probabilities, I'm going to throw this in here now. Probabilities tree are known as risk neutral probabilities. Okay, now what is that all about? And by the way, one of the interesting things about this model is, and Black-Scholes as well, we don't need the actual probabilities in this model. It's kind of an amazing thing. We'll discover that the actual choice of probabilities does not affect the final result. But risk neutral probabilities are easy to calculate from the real world data. And let's just quickly review what these different risk preferences Um, so just a quick overview of risk preferences. This is what we assume in finance and economics, that there's really only three types of risk preferences we might encounter. So we start with risk averse, and that means an investor must be compensated. Or let's just say an investor um, seeks to avoid risk and requires compensation in the form of higher returns to buy a risky asset. There's something other than the risk-free asset, meaning something other than treasury securities. So let's say, just as a quick example, if an investor can buy a 30-year treasury bond with a yield of 5%, then he or she will require a higher yield to buy a risky corporate. Okay, so if Apple has a bond paying only 5%, they won't buy it because it's this, risk. Apple is a very strong company, of course, but there's still some risk. Any company can go out of business. So they might not have to pay too much more. Like you might be able to find an Apple bond with a yield of 5.3%, let's say, but there is going to be a difference. And a risk averse investor is not going to buy another bond unless they're compensated for it. Now, then we have the idea of the risk neutral investor. And you might say, well, this is crazy. But remember, these are theoretical results. And you'll see why it matters. A risk neutral investor is completely indifferent to risk. This investor would accept a 5% yield for any income. It's all the same to them. 5% treasury bill, AA bond, who cares? That's what it means to be risk neutral. And one of the implications of being risk neutral is that a risk neutral investor would accept the risk-free rate of return from any asset. Okay, that's all we're looking for. Anything else would be icing on the cake. Okay, we're just going to go out and invest, and we're going to look for that risk-free rate of return. And then the third possibility is we call it risk seeking. Again, these are theoretical results. We're not saying that anybody falls into one of these categories. A risk seeking investor derives satisfaction from risk and will actually accept a lower return, leave it, from risky assets than risk-free assets. They love to gamble. That's the whole point. This investor would accept a yield below 5% in exchange for buying a risky asset. Remember, before we said that the risk-free rate is 5%. Now, do such people exist? Maybe, who knows? It's hard to say. It's not likely. So in practice, what we see is that investors have different levels, or they exhibit, let's call it, based on their market behavior, different levels of risk aversion. For example, a retiree might only invest in treasury securities because they're worried about they don't want to lose all their money after they've retired. A recent college graduate might buy a double B bond with a very high yield. Why? Because, well, you're 23, you lose your money. What's the difference? You got a long career ahead of you to replace all that money. So you might be attracted by that huge promised yield. Let's say you found a double B bond that's offering 8, and you say, well, 5, I can get 5 in the treasury market. Maybe I'll try this one. And what's interesting about this is that studies have actually shown that you actually could do very well if you buy a diversified portfolio of relatively risky bonds um, because bankruptcy is a very rare event. I mean, it does happen, but if you don't just put all your money in one bond, but if you have a portfolio full of these relatively low rated bonds, historically, you've actually made out quite well. And so it's up to the individual. But if you notice when you go to look at your company's 401k plan or whatever you've got, they don't normally offer you the opportunity to buy individual stocks or individual bonds. It's always a fund of some kind because they know that a fund which consists of a very large number of securities is much safer than a single bond or a single stock. So in other words, they don't want retirees losing all their money. So what they might do is say, listen, we got this bond fund where there's a lot of relatively risky bonds. And we'll call that our high yield fund or something like that. And then we have this other one where they're all basically treasuries, and that'll be our secure income fund or something like that. And then you can decide which ones you want. But they're not going to say, listen, do you want to buy, like Ford bonds or something? It's always going to be a fund. Okay. So anyway, so with all this being said, and by the way, there are studies that have tried to figure out how risk averse people are and all this and that. But so what's going to happen here is that because of the way the Black-Scholes model is structured, in the Black-Scholes model, the price of an option is actually independent of the risk preferences of investors. And that's because, if the price doesn't have a certain value, there will be arbitrage opportunities. So in other words, people's fears about risk and all this and that will affect stock prices for sure. They can affect bond prices again for sure, because who knows what might happen in the future. But with a derivative like this, the price has to be at a certain level, consistent with the assets or the options, asset, the strike price, the volatility, all the rest. So risk preferences are independent when we're modeling derivatives, in particular options. Nobody's opinion is of any consequence when it comes to pricing options. They are what they are, because remember, this is coming from an arbitrage-free relationship. If you disagree with the price of an option, you can feel free to buy it or sell it, but it doesn't change anything. Whereas with stocks, if people get nervous about a stock, it could send the price plunging. That's not going to happen with option prices because their prices don't depend on that type of thing. Although, I mean, eventually, I mean, if the asset underlying it is bouncing around, that could affect it. But the actual value of an option at any given point in time does not depend on anybody's risk preferences. So that being the case, the Black-Scholes model is therefore based on the assumption of risk neutrality, because this means that risk-free rate can be used to discount all cash flows. Notice it's easy. If I tried to use a risky rate of interest, I'd have to start worrying about risk preferences, and that's going to be very difficult to model properly. So we're going to use probabilities that are consistent with risk neutrality, and then we're going to use that to discount all the cash flows using the risk-free rate of interest. Okay. So when you see what we're doing, you'll say, well, wait a minute, why are we using risk neutral probabilities when investors are not really risk neutral? Well, it's because the risk preferences are irrelevant. Anyway, so we're going to make some assumptions about the statistical properties of the underlying asset. So by the way, we're going to assume something interesting here. We're assuming that the price of a stock. So this is the stock price, ST, is normal. Now, since we are using continuously compounded returns in our option pricing models, that implies that, whoops, I just realized I made a grammatical error here. Normally distributed prices implies that the continuously compounded rate of return is what we call log normally distributed. Which implies that log x. So here x is normal. Then over here, this implies that log x is normal. So the returns are said to be log normal. And that's kind of important because you can see here that, oh, I'm sorry. I just realized I said this backwards. My fault. Sorry. Nope, nope, nope. I just realized. Sorry. Nope, nope, nope. These are the prices. These are the returns. And specifically continuously compounded returns. And that means log ST over ST minus 1. Much better. Okay. So in other words, we did say up in the beginning that it's the returns that are normal. That's what we're focused on. But that implies that the prices themselves are log normal. Okay. So in the model, we're assuming that R, and by the way, we're going to call that R, the log of ST over ST minus 1 follows the normal distribution. And then the prices themselves would be log normal. And that's all built into the model. I mean, it's hard to tell by looking at it, but that's what's being assumed there. And so what we're going to do here is, as I said, we're going to assume that the stock evolves according to a multiplicative model, meaning that it goes up and down by a constant percentage or a fixed constant, as opposed to an additive process where we keep adding a certain amount to it each time. Instead, we're multiplying it. Okay. That's a consequence of, by the way, of this assumption of log normality. Okay, so in other words, we're modeling it as a multiplicative process. It goes up or down by a certain amount, which is a multiple, not a sum. And as I said, how high and up, how far it goes. Let's say you have a stock that's very stable. It stands to reason. And here's the one that's obviously very volatile. That the spread between the top node and the bottom node is higher when the asset is more volatile. Okay, so now we're going to look at some formulas. Now, by the way, we're going to do the following. We're going to let little g here be the real world probability of a stock going up or down. P is the risk neutral probability, which is what we're actually going to use. But the reason why this is here is so you can see when we're done that the g's do not figure into the value of the option at all. Now here I see that we're going to use K for the strike price. That's okay. Like I said, sometimes we use X, sometimes you use K. The Cox-Russell-Rubinstein model uses K. So we want to be consistent with that. R is the risk-free rate of interest continuously compounded. Delta T, by the way, is going to be the time in between these steps, as they're called, these time steps. Okay, this is T0. We always use 0 for today, by the way. So this, by the way, this delta T also is a constant. In other words, as we go through the model, the time steps could be, let's say, a month, or it could be a week or a day. It's always the same. It never changes throughout the tree. Okay, that would introduce changing, letting that change would make it a lot, and I mean a lot more complicated. Now, some of these binomial option pricing models that have been published do allow for that, but they're really complicated. Now, here's the interesting thing. For each stock tree, we're going to need an option tree to show the corresponding values of the option. Okay, so as we're going to develop or create them both at the same time. So for example, if we have this as our stock tree, let's say this is a 2-period model. That means T equals 2 is the maturity date of whatever option we're pricing. On this side of the fence, we're going to use the letter F. Now, actually, we don't normally use the 0 here. We're just going to call it F. You might say, well, why don't we use C for call and P for put? Well, that would be nice, but the problem is then the P's would get confused. Well, the internet just crapped out on me there. Now, sometimes when this happens, I end up with multiple recordings, and it's possible that this time that's exactly what we're going to get. I don't know. I'm hoping that we didn't lose the first half of this. I don't see anywhere where it's trying to save what I've done. Oh, I'm going to be annoyed because that was 45 minutes there, potentially down the drain. So I'm hoping that the entire thing survived. Otherwise, I'll have to start doing this in 10-minute blocks because I can't risk losing all that work. But anyway, let's just assume, I'll tell you what we'll do. Let's assume that somehow, by some miracle, the first half of this was saved. I'm going to do a few more minutes and then stop just to see what happens, because I might have to start all over again. So let me just carry on with this discussion. And so what I was saying is that if the stock price tree looks like this, the option price tree looks like